Hey guys, it's Cameron here with Emerson Property Management. Every week, I bring you tools, tactics, strategies, lessons I've learned, things that have helped me build up a sizable, chair's kind of sitting odd, sizable rental portfolio in about 2 years. Now, today I want to talk about types of properties to avoid as a beginner. So I saw this on Instagram on Invest for More, F-O-U-R, more. I guess handle or whatever you call it, you dang kids call it nowadays. Invest for More by Mark Ferguson's the guy. He's written a couple books on real estate. He was an engineer turned real estate investor. And he put this post on here, and I took out some. I've kind of tweaked it a little bit, but he's got some good stuff. He's actually a pretty intelligent investor, and I think he's got a good mindset. He's not one of those that's trying to sell you into some crap. He actually, it seems like he really wants people to do well, and he's got a good strategy on what he uses. He buys long-term cash flow producing assets, rentals, commercial buildings, stuff like that. But he had this post, and I thought it was really good. It was types of properties to avoid as a beginner. So when I read through this, like I said, he had a couple more on here that I didn't think were pertinent, but the ones that I liked that he had were negative cash flowing properties, full retail, large remodels, and high vacancy properties in high vacancy areas. So what do those mean? So negative cash flow. I know I've got another video on that you guys can find up here somewhere on how to analyze a rental property and walking you through that. So check that out. You never, especially as a beginner, you do not want to buy a negative cash flow producing property. Now, I say never. If you're an experienced investor and you have other cash flow producing assets, maybe you buy this as a play to add value to something else, or maybe add on to your existing portfolio on this certain plot, or put some pieces of land together. So I can't say never. I shouldn't say that. But as a beginner, never buy a negative cash flow producing asset as a beginner as your first investment, ever. Because you don't know shit about investing, especially rental property investing. I didn't know shit. It just you can't know the stuff that you need to know by reading books until you get into it. So you want to have cash flow to act as your cushion. So when you make a mistake and you don't do this right, and you cut this corner, or you let something go, you have cash flow to cushion your mistakes. So never, ever buy a negative cash flow producing property as your first investment as a beginner. The second one is full retail. So if a property is priced at $200,000, don't pay not priced at, because people, you guys will probably see this if you're looking for properties. Sellers will put their property, whether it's worth 200, if it's an example, if it's worth 200,000, they might list it at 215, knowing that you're going to lowball them at 200, and then they walk away with their $200,000 house. It doesn't matter what the property's listed at. I never look at what the property's listed at. I do not care what the asking price is, because I analyze it for cash flow. I analyze it as an investment. I don't care if the property's listed at $500,000. I've offered $100,000 less on a property before. Didn't get it, but it did not make sense where they were asking. And that property sat on the market for like a year, because they even knew that they were asking too much for it, but they didn't care. So that's not the seller that you're going to land. Never paying full retail means that if a property is worth, as in appraises at $200,000, you do not want to pay $200,000 for that property. Why? Because again, you don't know anything, or not anything, but you don't know about how to manage properties, what you're doing right now. You're beginning, you're starting, you can't know everything, and you need equity, i.e., the difference between the value and your loan. That's equity. You need equity to cushion your mistakes. If you make a mistake and do a shitty remodel or hire a bad contractor and the property value goes down, you want to have equity, so if it goes down, you still have some cushion left. If what you did knocks the property down from $200,000 to $190,000, you want to be in the $150 to $180 range of what you paid for it. You don't want to be paying $200, make a mistake and knock it down to $190, and now be in the hole $10,000. You want to pay $170 for it, not if it comes down to $190. Who cares? You still have $20,000 in equity. And when you buy those properties, especially ones at discounted value, your returns are just through the roof. If you buy a $200,000 property for 180 grand, you just made 20 grand, 20,000 bucks, like that. When the property appraises, and you will have to get it appraised if you have a loan, when you get that property appraised, it will tell you exactly what it's worth. Boom, it's worth 200 grand. You paid 180 for it. Boom, you just made 20 grand. Again, you'll have to minus your closing costs, commissions, and things if you would go to sell that, but you have a $20,000 cushion. So that's why you don't pay full retail. If it's worth $200,000 on the appraisal, you do not pay $200,000 for it. You need a discount. And you guys will see when you start analyzing rental properties that you need to pay a discount to make the rental property numbers work. Third, large remodels. So let's say you find a house, oh my gosh, this is perfect. It's, normal properties in this price range or in this neighborhood are 200,000. I found one for 100. It flooded. It's a total gut job. It'll be perfect for my first property. Wrong. Why? Because you guys, again, as a newbie, I didn't know it either. You don't know what you don't know. You don't know how to manage contractors. You might not even know how to pay contractors. You don't want to give them all the money up front. People give them money up front, they go away, and they never see it again. So there's things that you don't want to take the risk on, especially with a large remodel. So you don't want to spend $60,000, $80,000, $100,000 on a remodel when you never have done a remodel before. Different if you, as a beginner, are a contractor. That would be a perfect property start. You know remodels like the back of your hand. But for most investors who have not managed contractors before, do not take on a large remodel. Please do a paint and carpet, do something small, maybe some countertops or cabinets, but do not do a full gut job, a 30, 40, 50, 100, $150,000 rehab. It might work out well for you, but the odds are it will not. The fourth and last one is high vacancy areas. So what do I mean when I say high vacancy, and how do you find vacancy? Well, high vacancy areas are areas where you have a lot of turnover. So these are D-class, C-class neighborhoods, transitioning areas. If you guys haven't checked out the video, see on why I don't like buying in these areas. And this is one of the reasons, because you're always dealing with a certain type of tenant that turns over, whether they have to be evicted or people steal stuff or their job is always at stake. High vacancy areas are spots where it's hard to make money. And I say that because vacancy, not bringing in rent every month, is huge. If you have a 10 or 20% vacancy, that can be, especially for single family, for large multifamily, 10% usually isn't a big deal. But if you're sitting at 10, 20% for a single family, you have some serious problems. And I really don't know how you make money. Now this is for long-term, this is not short-term rentals. Those are different, very, very different ballgame. But for long-term rentals, you want to make sure that you have a vacancy rate very low. You want to keep people in the property. When people come out of the property where it's vacant, there's higher risk of theft. There's higher risk of vandalism, of a water pipe bursting. The property's vacant. You walk in and a pipe burst and nobody was there. So now it's just all your floors are ruined. You have to redo it. You're going to have to file an insurance claim. And who knows? I don't know if your deductible's $1,000, $2,000, $5,000, $10,000. You could be coming up with quite a bit of money out of pocket. So do not buy in high vacancy areas. Buy in solid markets with good schools. I play in the B and C areas, upper C, lower B class markets, and that has always suited me very well. A class, too expensive. D class, too risky. So those were the four, guys. I'll reiterate: don't buy negative cash flowing properties. Don't pay full retail. Don't do large remodels, and don't buy in high vacancy areas. Again, this was the original post was an Instagram post I saw from Invest for More. I think it's investformore.com by Mark Ferguson. I'll have the link or something. I'll share him. I don't have any affiliate or anything with him. I just thought this was a good post and saw something that you guys might like to see, and I thought that could add value to you guys. So I hope you guys find that valuable. If you did, let me know, and otherwise I'll see you all next week. Thank you.